Welcome, everyone. Today is Friday. My name is Denver Noahs, president of Wealth for Life. Today, we're going to do our recap of the Modern Family Dynasty newsletter. We do that every Friday. And you can find a replay of this in the Wealth for Life group or on YouTube, and make sure you subscribe to the Wealth for Life newsletter. But today, we're going to go ahead and jump into it. The headline, of course, for today was you probably own this asset that has earned nothing for the last 10 years. And of course, that's related to bonds and fixed income. You've probably seen headlines like this all over the place. You know, the worst US bond sell off since 1787, bond market implosions, and everything else. And, obviously, it's been a terrible time for bonds. And, I'll kind of zoom into this chart that I have in this week's newsletter. But if you really start looking at the bond returns, this is not a new problem. And this is something that I'm kind of highlighting in this week's newsletter. This is the 10-year return of fixed income markets, all those market indexes in the fixed income space. And you can see they are pretty much all pretty crappy. So negative on the global side, even 1% on the Barclays US Aggregate Bond Index. That's the 10-year return. And so this is not a new problem. Yes, the losses are bigger now, but for a lot of Americans, they probably don't realize how much they've actually had parked in fixed income bonds strategies over the last 10 years that wasn't earning any money. And because if you think about one of the most popular vehicles for 401ks is target date funds. So the idea behind a target date fund is the closer you're going to get to retirement, the more money is going into bonds. So if you're 55, that number could be 30% or 40%. And as you get older, 40, 50%. So there's millions of Americans that had huge chunks of their money invested in an asset that didn't earn any interest for the last 10 years, not even aware of it. And most people just don't look at the fixed income side of the portfolio, especially over the last 10 years. Everyone's always looking at the equity side and the indexes, because those are what everyone's paying attention to on the S&P and stocks and things like that, without ever realizing, well, how much money do I actually have sitting here that's not earning a lot. And that's, again, it's something I kind of highlight often, is because of Wall Street tends to promote one product. They sell one product. Now, even though, like myself as a fiduciary, I use investments, but they also use other strategies, because there's so many other ways that you can actually create safety, get better yields. And there's a lot of assets that outperform bonds that were safer over the last 10 years, but people don't use them because it's like when you go to, your kind of standard advisor, they sell one particular product. And that's why it's important to kind of start playing offense and defense. I'm going to get into that a little bit. And as we kind of jump into the next chart, because they're both kind of related, in the next, so we have this bond issue where people had so much of their money earning, zero for the last 10 years. And of course, now you have also this debt crisis issue that's brewing. Well, what does that mean? So when you have these economic incentives over the last decade, which is low interest rates, and then you follow that with excessive government spending, what you have is all this money getting injected in capital purchases. It's called pulling demand forward. So what that means is people start buying things they wouldn't normally buy, or businesses start making more purchases they wouldn't normally do, because they have basically cheap access to capital. And that's what you kind of see on this chart here this is 2010 up to the present. You can see the low interest rate environment, right, that we had for nearly 10 years. And all of that starts to pull demand forward, meaning stuff that you would have maybe bought 3 or 4 years from now, you're buying it sooner. And so same thing happens. Government interjects money, lots of extra money in, infrastructure spending, everything else. Yes, that adds value, but also businesses now have extra cash, so people are buying stuff in advance. So you're pulling demand forward, meaning that there's less demand in the future. You're kind of borrowing against that future demand. So that's the issue when people start looking at now and slowdowns and what happens next. Well, when the incentives are gone, low interest rates, like you see on mortgages, mortgages running at, hitting 8% on a 30-year fixed rate mortgage, demand starts to slow down. Corporate credit, cost of corporate credit is up. Corporations borrow less money. Expansion slows down. So you have this kind of pressure that starts to push slowdown when those economic incentives change. And that's why it's always a good idea to kind of start playing defense and having defensive assets. So related to what we've been talking about, even on the bond side, where most people they're in this area where they have stocks and bonds. They don't particularly have any control over what's going to happen in the future. So instead, the common theme of mine in the planning side is we're always looking at, let's separate assets into offensive, defensive assets. Two categories. Defense is going to have more protection, cash flow, make sure money's coming in no matter what's happening in the world. Offense, of course, is swinging to the fences. And what has been the kind of standard mode of Wall Street is that they're all the same. All you have to do is buy one asset class according to Wall Street, and everything's going to be fine. And that's the stock and bond side. But really, when you start looking at what do high net worth investors doing, and as someone who's been working with high net worth for 20 years, it's dramatically different advice. And people always ask me, do the wealthy do different things? They absolutely do. So again, it's back to on this center slide here, what you get, the 99% gets advice that's investing in stocks. And so when people are thinking about diversifying and asset classes, and you go to the standard advisor, it's kind of like going to a butcher and saying, hey, can you, what are you going to buy when you go to the butcher? Well, you're going to get meat. That's because it's a butcher. That's what they sell. You're not going to get seafood. You're not going to get other things. And it's like, again, you see these kind of people on CNBC and everything else, and they might be a wonderful fund manager. And they go, hey, this is so-and-so. They manage X amount of dollars. They have these ETFs in their portfolio. Hey, what do you think we should invest in? Well, I think you should invest in ETFs and buy in the market, right? That's what they sell. And it's just remarkable to me that the whole state of financial advice revolves around people giving advice to buy the things that they sell, the one thing that they sell. Now, what the fiduciary mindset is supposed to be is, hey, we're not captive to any one particular asset. It's about listening and cherry picking, what are the best strategies in the market and what's available. And that's why there's so much else kind of below the surface and other ways to do that, other ways to grow wealth. And you don't want to get stuck in this situation where you're just following mainstream advice. I call it the one thing retirement plan. So that one thing needs to happen, you're after all your years of hard work, and I don't care whether you're 20 years from retirement or you're entering into it, where all of a sudden you get down there and everything that happens afterwards is outside of your control. And that's what happens when people have all their money in stocks and bonds. Like if it performs great, like it did the last 10 years in the era of low interest rates and high spending from the government. But when those incentives change, and if the market goes back to more normal up and down cycles, right, that's just not where you want to be. You want to be in this position where you're exercising more control. And that's what true financial security is, the ability to control assets, control taxes, control income. And it is possible. You just have to use different types of assets. And we're going to go over that a little bit more on the event that I have next Thursday. This is part 3. I know a lot of you have attended part 1 and part 2. If you have not, and even if you have, there's going to be a lot of new stuff we're going to go over. I will review the tax strategies you can use to cut taxes by 50%, because that's hugely important. And all the new stuff we're going to go into is how do we structure assets with everything that's going on in the world. So while the last one's covered a lot on the tax piece, this one will cover the tax side as review on how to cut taxes by 50% using some of these more advanced strategies, but then also what are the asset structures and assets you can use to kind of create these unbreakable income streams and put yourself in that unbreakable financial position. So if you're not already registered, you just go to 5xevent.com. It is on LinkedIn. It's a LinkedIn live event. So if you're watching this on YouTube, make sure you go to 5xevent.com. You can register there. All right, so those are the first 2 sections of the newsletter. Each week we do the learn section, chart section, and the next one is productivity. My tip of the week is using this product called Perfect Aminos from Body by Health. So it's basically an amino acid protein that gets absorbed very readily in your body. And I've noticed a huge impact of just when I'm working out and recovery and strength and sleep and muscle building and everything else, because most proteins actually aren't absorbed that well. And I used to think like, man, if I need to get more protein to try to build muscle or just stay in reasonable shape, you got to eat more and more whey protein and eggs and meat and fish and everything else. But what I learned about Body by Health and the Perfect Aminos is that if you look at the chart, you'll see that it's not about how much you eat, it's about how much your body actually absorbs and utilizes. So things like eggs, your body's able to only get 48%, which that's one of the best sources of protein, and it keeps going lower and lower on the other ones. Where with Perfect Amino, you can have a couple of scoops. I mix it up in my drink. It's delicious. And, your body's absorbing 99% of that. So I've really noticed a big impact on not getting as sore after workouts, and helping me out with energy. in a lot of things. So that's my productivity tip of the week. There's even studies that show, again, as you're getting older, taking it before bed gives your body some great fuel for recovery, so you can not lose muscle mass and things like that as you're getting older. So perfect amino, great stuff. And then the final section is, of course, I go into the concept of the week. This is one I'm always harping on. Currently, the top 10% of Americans pay 70% of all federal taxes. And if you're watching this, you probably know that. Most of the people watching this are in that top 10%. So that's incomes probably from 150K to $1 million. When you're in that group, you're getting pounded with the full force of the US tax code. You can end up paying the highest taxes, 30-40%. You kind of lose a lot of the incentives and everything else and subsidies. So you're right there trying to get over the hump. You start getting successful and taxes are pounding you down. So it's kind of stop chasing rate of return. Work on protecting wealth from taxes. It's easier, it's safer, and it can have a much more dramatic impact than trying to go out and chase rate of return. And one thing I hear all the time when I'm doing planning and strategies, we're always focusing on tax reduction. And I hear from people all the time that they've never even had advisors go through this stuff with them at all, because everyone's focused on rate of return. It's a much easier conversation. Let's just invest, try and get a higher rate of return. But if you can go down and you can stop 20% of going away to taxes per year, or you can build some tax-free income streams for the future, I mean, there's literally hundreds of thousands and millions of dollars that you can recover and keep growing by doing tax protection. So it's always a foundational piece to start from. Again, we'll talk about some of that next week in the webinar. But make sure, if you're not already in the Wealth for Life group, that you join that. It's the wealthforlifegroup.com. It's on LinkedIn. It's just a place where I share, some of the more details on some of these high net worth strategies, because a lot of these are strategies we don't want all over the internet, because they kind of get, taken apart and abused in the wrong ways. And so it's more of a community where there's a little more privacy. We can share these different strategies, all the things that I'm learning from my high net worth clients. That's where I get a lot of my best ideas. Like, what are those people that are worth 10 and 20 and 30 million doing? I'll learn strategies from them, bring them into the group and share them. And so that's a great resource. So make sure you join the wealthforlifegroup.com. All right. So that's our recap for the week. My name is Denver Noes with Wealth for Life. Thanks again for watching, and reach out if you have any questions.